Since late 2025, intense downward pressure has gripped the markets, and nearly $1.45 trillion in total crypto valuations has shattered. This measures that pressure. The Fear and Greed Index is pinned at a 16-month low, hitting 10 out of 100, or extreme fear. XRP is at the center of this downturn, dropping 51 year. Portfolio strategies are broadening. 56% of these firms are now diversifying beyond the simple Bitcoin and Ethereum binary. 66% of these entities use strictly regulated wrappers like spot ETFs to gain their exposure. XRP has emerged as a primary target in these plans. 25% of institutions in the survey plan to add it to their portfolios this year. This intent is already translating to execution. A recent 13F filing shows Goldman Sachs holding a $153.8 million position specifically in XRP ETF products. As a result, XRP ETFs have recorded $1.21 billion in inflows, heavily outpacing competitors like Solana and Dogecoin. Institutional volume is largely bypassing retail exchanges, flowing directly into regulated asset wrappers with a clear focus on XRP. Why is the world's heaviest capital targeting XRP now? The driver is legislative. The market is awaiting the Senate markup of the Clarity Act. This bill classifies assets like XRP as digital commodities. That classification provides the legal safe harbor that pension funds and banks require before they can engage with the spot market. Compounding this regulatory shift is a pending $1 billion SPAC merger involving the XRP ledger. These firms are positioning ahead of federal legislation to secure equity in the next generation of cross-border financial infrastructure. Look again at that $1.30 price point through this institutional lens. This chart pattern is known as a coiled spring. Realized volatility has reached cycle lows, indicating supply and demand are perfectly balanced. This sideways action is a mechanical footprint. Large firms suppress the price to fill massive buy orders without triggering a breakout. Flat prices during periods of extreme retail fear are a signature of the accumulation phase. The 2026 market is moving away from purely speculative volatility. It is now defined by institutional market structure. Retail traders are selling based on short-term price charts, while institutions are buying based on structural legislative data. A large-scale transition of capital is completing in the shadows of this market suppression. The list is made. The orders are being filled. Are you holding what the 25% are buying?